So when you look at Bitcoin itself, the moment the ISM, we've had this very low period of ISM, and that was driven by this very flat dollar, and also by rates staying higher than normal. But as the ISM starts crossing 50, economic growth comes back, earnings come back, household earnings come back, stuff gets reinvested in markets. So at this point is when Bitcoin super accelerates. And that point lies ahead. We're about to see that point now. Now, I haven't shown it on this presentation, but we've also imputed how it reacts to ISM. And if we get to that 57 ISM, that puts Bitcoin at 450,000.
Over the past several months, Bitcoin and the broader crypto market have staged a remarkable comeback, fueled by rising liquidity, institutional adoption, and growing speculation about the next phase of the economic cycle. Spot Bitcoin ETFs have played a pivotal role in attracting new capital. At the same time, expectations of a shift in Federal Reserve policy, from tightening to easing, have injected fresh momentum into risk assets. Yet, despite this rebound, many investors remain cautious. Is this recovery sustainable, or are we simply witnessing another cyclical top before the next downturn? Amid this debate, Real Vision founder and CEO Raoul, a veteran macro strategist and former Goldman Sachs executive, is making one of the boldest calls in the market today. In a recent keynote presentation, Powell projects that Bitcoin could climb as high as $450,000 in this cycle. A target that, he argues, is grounded not in speculation, but in the mechanics of global liquidity expansion and the structure of the debt cycle. According to Powell, the key to understanding crypto's next phase lies in the interplay between global money supply growth, central bank policy, and investor risk appetite. Forces that are now converging to create what he calls the ideal conditions for Bitcoin's next major acceleration. As we go through selected clips from his presentation, we'll explore the data-driven framework behind his projection, the breakout in global M2 liquidity, the historical correlation between liquidity cycles and crypto bull runs, and the critical role of debt refinancing in fueling new waves of monetary expansion. If you appreciate detailed, macro-driven crypto analysis like this, consider supporting the channel by liking this video, subscribing, and turning on notifications so you never miss an update. Now let's dive into Raoul Pal's breakdown, starting with his $450,000 Bitcoin target and the macro triggers he believes will drive the next leg higher.
So let's look at this liquidity cycle, break it down a little bit. So when you look at it, global M2 is a good proxy for total global liquidity. Why I use this on these charts is it's more real time. Total global liquidity is takes a longer to calculate for the various data inputs. But global M2 does a very good job. Again, like the dollar version, this is wildly outperforming what happened at the Trump previous cycle. So we've got plenty of dollar liquidity. Global M2 is driven by two things: the dollar itself, which is why it's accelerating so much, and then the global financial system, that's the banks. And what they're doing now, all of the governments around the world and the central banks are forcing the banks to buy debts. Basel IV is the reason behind that. The new changes to the SLR in the US. All of this is a way of forcing bonds and debt into the banking system, and then forcing the banks to create more money using them as reserves. It's just another way of debasing the currency. So global M2, when we look at it outright, it does the same pattern every time. These patterns repeat not out of voodoo, it's because it's driven by the debt refi cycle. The average maturity of global debt is 4 years. They're all between the 3 and 5 year sector. There's some long-term debt. Nobody can issue long-term debt because the market won't absorb it. So what we find is we're shorter term. Every time we do this, we have a breakout, a retest. So this was the 16-17 cycle. This is the equivalent one I think now. Breakout, retest, explodes higher, does this whole liquidity tightening. That's the bear market. That's when the economy slows down. That's when rates go up. Does the same thing. COVID gave it a false, a double shot. It did it again. We're doing exactly the same thing. It's almost a complete repeat of the 2017. So what we're seeing is global M2 at all-time highs. That should mean all-time highs for asset prices. That's how the world works. What we've also got here is global M2 against Bitcoin. So it's the same chart, but now we can see what happens to Bitcoin every time this happens. It breaks out, retest, and then Bitcoin starts hitting the next leg of the banana zone. Usually you start the banana zone a bit earlier with the breakout, you have the correction, and then it goes. And I've talked about this, there's 3 phases of the banana zone. Phase 1 was Q1 last year, as we started to break out in all these measures, new all-time highs in liquidity, Bitcoin goes to all-time highs. We have the corrective period, which is the correction zone, and then we get the banana zone part 2, which is usually alt season. This is the fabled chart that everybody in the world has copied from me, but this is the global M2 chart versus Bitcoin with a 12-week lead. It's been like voodoo. It is the most voodoo-like chart I've ever come across, and it works. Will it work entirely? Often what you find is later on, Bitcoin outperforms global M2 because of the speculative mania that builds over time as people realize what's going on. What it tells us is the back end of this year is basically a one-way street with a few corrections. The corrections will be normal. You will be questioning me saying, is it all finished? Is the banana zone finished? Is it all over? Do I need to get out now? And generally speaking, just follow the money. It really is that simple. The other thing is, okay, well, with the dollar and the banking systems doing this, well, the other thing that's doing it is the central banks. China is starting to print money. China has, I think, by my measure, 3 to 4 trillion to print, but they need the weaker dollar. They need to agree the tariffs with the US. In exchange, the US will continue to weaken the dollar. They will allow the dollars into the Chinese system so they can refi all of the dollar debts. And a lot of China debts, all of the corporate debts are in dollars. So what happens is we're starting to break out, and that adds to this push of liquidity. So it's not just the weaker dollar itself, it's not just the banking system, but it's the central banks starting to pump liquidity into the system as well, because they've all got to roll the debt. And that's why it is so cyclical. Every time the total global liquidity index breaks out, again, the same thing with M2, the market goes higher. And the reason being is I talked about the correlation. Well, here's the chart. It's a 90% correlation with weekly global liquidity. That's Bitcoin. And the NASDAQ is a stunning 95%. And so it's hard to refute that this is not what is happening. It's so obvious, but most people want to refuse to believe it. They start mid-curving the whole thing, saying, well, that's not the printing of money, and this is not how it is. It's so clear in the data. It's so obvious that this has been going on. And even when you listen to Scott Bessent speak or Janet Yellen speak, they all talk about this. They talk it about in the terms of basically the everything code framework.
Powell's framework centers on a critical driver, the expansion of global liquidity, measured through metrics like global M2. Historically, each breakout in liquidity has coincided with powerful rallies across equities and crypto markets, and Powell points to a near 90% correlation between global liquidity and Bitcoin's price action over time. But what makes this cycle distinct is the scale and coordination of liquidity injections now underway. Around the world, central banks are being compelled to expand balance sheets, partly to manage sovereign debt loads and partly to refinance trillions in maturing debt over the next few years. Powell notes that new regulatory frameworks, such as Basel IV and changes to the U.S. supplementary leverage ratio, are effectively forcing banks to absorb more government bonds and, in doing so, expand the monetary base. At the same time, China is quietly stepping up its own liquidity injections, creating an additional layer of global monetary easing. According to Powell, these combined forces are driving global M2 to all-time highs, setting the stage for renewed asset price appreciation, including Bitcoin and other crypto assets. Importantly, Powell frames this within the context of the debt refinancing cycle, which operates on a roughly 4-year rhythm. With most global debt structured around short to medium-term maturities, waves of refinancing force liquidity injections at regular intervals, creating the repeating patterns we see in asset markets. This, he argues, is not financial voodoo, but the structural reality of how the global financial system functions. And as liquidity expands, the excess capital tends to flow into risk assets, starting with large caps like Bitcoin and the NASDAQ, before cascading into smaller altcoins as speculative appetite grows. Let's get back to Powell's video.
Business cycle. Business cycle is currently weak. The business cycle is the most important cyclical factor. It drives, it's part of the global liquidity construct. So the business cycle actually came out today or yesterday at 48.7, slightly weaker as we've been expecting. Bitcoin's already priced it down to 47.4. So Bitcoin's already priced in the bad news. But the good news is financial conditions lead it by 9 months. It's a very useful tool. And it's telling us that we're going to see the business cycle pick up super strong. And this will keep going. I think we'll end up in the 60s. It also prices Bitcoin by doing this. And so when you look at Bitcoin itself, the moment the ISM, we've had this very low period of ISM, and that was driven by this very flat dollar, and also by rates staying higher than normal. But as the ISM starts crossing 50, economic growth comes back, earnings come back, household earnings come back, stuff gets reinvested in markets. So at this point is when Bitcoin super accelerates. And that point lies ahead. We're about to see that point now. Now, I haven't shown it on this presentation, but we've also imputed how it reacts to ISM. And if we get to that 57 ISM, that puts Bitcoin at 450,000. Is it exact? Will it be exactly that? No. But all of the people who are saying it's going to 150, 250 are probably scarred from last cycle without looking at the forward-looking data. So it's incredibly positive for me. It also is what drives altcoin season. So the fabled altcoin season, everyone's like, it's never going to happen again. It's just a function of the business cycle. Why? Because household earnings are still subdued, because the business cycle is subdued. Average businesses outside of technology have subdued earnings. The moment the business cycle picks up, everyone has spare cash. Cash gets recycled into assets. People move further out the risk curve. So altcoins are exactly the same as credit spreads, small caps, emerging markets, junk bonds, all of this. They're all exactly the same thing. The further out the risk curve, the business cycle actually drives all of it. It's also the same with fine wines. It's also the same with Rolex watches, all driven by the same thing. So we all want to see the ISM above 50. We've got the forward-looking data to say it's going to happen pretty soon, and that's going to be a very big signal to us. Usually that will happen as Bitcoin starts breaking all-time highs, which we imagine should happen pretty quickly, because that's every time that happens when we start to see these liquidity conditions. But the problem is nobody believes me. Everyone's like, no, but the markets and Trump and tariffs and geopolitics and China and then Russia and that's all and what you've all done is price in maximum f***ing fear. At every point, you've got, this is number of stocks with a 40 days RSI below 30. This was before the rally really started. One of the few ever, this is the same as we had at COVID, when the world shut down. It's the same as the Russian default and the Asian crisis. People are crazy with fear. Investor Intelligence Survey, percentage bullish, all-time record lows. The least bullish people have ever been in history. And the forward-looking indicators tell you the economy is about to explode higher, and people are massive bearish. What was interesting is we just saw the charts coming out today was that retail investors had been buying the dip. Institutions still haven't. They're all massively underweight.
Despite widespread fear driven by geopolitical tensions, trade wars, and lingering doubts about global growth, the forward indicators are flashing green. The U.S. business cycle, tracked by the ISM index, is poised to shift back above 50, marking the return of economic expansion. And historically, this is the inflection point when Bitcoin and other risk assets accelerate sharply to the upside. Pal's model even projects that if ISM readings rise toward 57, Bitcoin could target levels as high as $450,000, a figure many dismiss as unrealistic, but one grounded in liquidity trends and business cycle mechanics that have repeated over multiple cycles. And it's not just Bitcoin. As household earnings recover and investors regain confidence, capital tends to flow further out along the risk curve, fueling not just altcoin rallies, but broader risk asset surges across small caps, emerging markets, and even luxury goods like watches and fine wine. Yet, as Pal points out, sentiment remains near historic lows. Institutional investors are still sitting on the sidelines, heavily underweight, even as retail participants have begun quietly buying the dip. This disconnect between forward-looking data and prevailing fear could create a powerful squeeze, driving markets higher as the wall of worry gets climbed once again. For well-informed crypto investors, the message is clear: track liquidity, monitor business cycle indicators, and stay grounded in macro realities, not headlines and fear narratives. Let me know in the comments. Do you think Bitcoin can really reach Pal's $450,000 target? Or are markets still too fragile? I'd love to hear your take. If you found this analysis valuable, make sure to hit the like button so more people can discover this content. Subscribe to the channel for ongoing, data-driven updates on Bitcoin, macro cycles, and crypto markets. Thanks for watching, and I'll see you in the next video.